Hey everyone! Ever wondered how to grow your money steadily without breaking a sweat? Let me introduce you to the world of SIPs, systematic investment plans. With SIPs, you invest a fixed amount of money at regular intervals, like monthly, in a mutual fund of your choice. It's like putting aside a little bit of money towards your financial goals, consistently. Instead of letting your money sit idle, you can start a SIP and watch it grow over time. The best part? You don't need a huge sum to begin. Small, regular investments can make a big difference in the long run. Investing might seem daunting, especially if you're a beginner. But SIPs are designed to make investing accessible and hassle-free. Once you choose your investment amount and frequency, the money is automatically deducted from your bank account and invested in the chosen mutual fund. This disciplined approach not only helps you stay committed to your financial goals, but also instills a healthy saving habit. By starting early and staying invested, you give your money the power of compounding, which is like magic for your wealth creation journey. In the next section, we'll delve deeper into the magic of compounding and how it works wonders for your investments. Compounding is the secret sauce that makes SIPs so powerful. It's like a snowball effect, where your money earns interest, and then that interest earns even more interest. Over the years, your investment, along with the accumulated interest, earns more interest, creating a snowball effect that amplifies your returns. The earlier you start, the more time your money has to grow. Think of it this way: the longer you let your SIP run, the more time it has to benefit from the power of compounding. It's like planting a seed and nurturing it with regular watering and care. Remember the snowball effect we talked about? That's the magic of compounding in action. And the best part? Those returns start earning returns too. It's like a chain reaction of growth. Imagine you invest 1,000 rupees today. It earns a 10% return in a year, turning into 1,100 rupees. The next year, you invest another 1,000 rupees. Now, the 10% return is calculated on 2,100 rupees, your initial investment plus returns, giving you 2,310 rupees. This continuous cycle of earning returns on your returns is what makes compounding so powerful. Now you might be thinking, but Minnie, what about market fluctuations? Won't they affect my SIP returns? And you're right to think that. The stock market is like a roller coaster with its ups and downs. But guess what? SIPs come with a built-in safety net. When the market is down, your SIP continues to invest regularly. This means you buy more units of the mutual fund at a lower price. And when the market goes up, those units you bought at a lower price are now worth more, boosting your returns. One of the biggest advantages of SIPs is their ability to average out the cost of your investments. This is called rupee-cost averaging. Since you invest a fixed amount regularly, you buy more units when prices are low and fewer units when prices are high. When the prices are low, you stock up. Similarly, with SIPs, you automatically buy more units when the market is down and fewer units when the market is up. This approach helps you average out the cost of your investment over time, reducing the impact of market volatility on your overall returns. It's like having a built-in shock absorber for your investments, offering a smoother ride towards your financial goals. Remember, Rome wasn't built in a day, and neither are impressive SIP returns. Just like any investment, SIPs need time to work their magic. The power of compounding takes time to show its full potential. So, patience is your best friend when it comes to SIPs. Think of your SIP as a seed you plant. You need to water it regularly, give it sunlight, and be patient. Over time, it will grow into a strong tree, bearing fruits of your investment. Similarly, your SIP will flourish over time with consistent investment and a long-term perspective. Exploring the SIP universe. A world of options. Just like there are different dance forms to choose from, the world of SIPs offers a variety of options to suit your individual needs and goals. Whether you prefer flexibility, consistency, or an extra boost to your investments, there's an SIP type for you. Understanding the different types of SIPs will help you pick the one that aligns perfectly with your investment style and financial aspirations. So get ready to find your perfect SIP match. Life is full of surprises, and sometimes our financial plans need to be as flexible as our dance moves. That's where flexible SIPs come in. Unlike regular SIPs, where you invest a fixed amount at regular intervals, flexible SIPs give you the freedom to change your investment amount based on your financial situation. Imagine you receive a bonus or have some extra savings in a particular month. With a flexible SIP, you can choose to invest a larger amount that month to make the most of the opportunity. Flexible SIPs are perfect for individuals with irregular income streams or those who prefer greater control over their investments. Now that you understand the flexibility of SIPs, let's talk about finding your investment rhythm. Just like you have a preferred dance style, you can choose a SIP frequency that suits your comfort level and financial goals. Daily SIPs, as the name suggests, involve investing a small amount every day. Weekly SIPs offer a balance between daily investments and monthly convenience, allowing you to invest consistently without feeling overwhelmed. Monthly SIPs are the most popular choice, aligning with most people's salary cycles. The key is to choose a frequency that fits seamlessly into your financial routine, making investing a habit rather than a chore. Section 4. Top-up SIPs, boosting your investment game. Imagine you're learning a new dance step and want to take your skills to the next level. You'd probably put in some extra practice, right? Similarly, top-up SIPs allow you to boost your investment game by increasing your SIP amount periodically. With a top-up SIP, you can choose to increase your investment amount by a fixed percentage or amount at regular intervals, such as annually. This strategy helps you make the most of your growing income and potentially enhance your returns in the long run. Top-up SIPs are an excellent option for individuals who anticipate an increase in their income over time and want to accelerate their journey towards their financial milestones. Section 1. Long-term investments, planting seeds for a fruitful future. Long-term investing is like planting a seed and nurturing it into a mighty tree. It requires patience, discipline, and a belief in the power of time. When it comes to long-term goals, like securing your retirement or funding your child's education, equity SIPs are your best bet. Equity SIPs invest your money in stocks, which have the potential to generate higher returns over the long run. By investing consistently in equity SIPs through market ups and downs, you can ride out the volatility and benefit from the potential for long-term growth. In the beginning, you don't see much happening above the ground. But beneath the surface, the roots are growing stronger, setting the foundation for a tall and sturdy tree. Section 2. Medium-term investments, navigating the growth path. Medium-term investments are like navigating a winding path towards your goals. You need a balance of growth and stability to stay on track. For goals like buying a car or funding a dream vacation, a combination of equity and balanced SIPs can be a suitable strategy. Balanced SIPs invest in a mix of stocks and bonds, providing a balance of growth and stability. Stocks offer the potential for higher returns, while bonds provide a cushion during market fluctuations. This diversified approach can help mitigate risk while still aiming for decent returns over the medium term. With a mix of equity and balanced SIPs, you can aim for growth while managing risk, potentially leading to steady progress towards your medium-term financial goals. Section 3. Short-term investments, riding the waves of opportunity. Short-term investments are like catching a wave. You need to be quick, agile, and ready to ride the momentum. For goals like building an emergency fund or saving for a down payment on a house, debt SIPs can be a suitable option. Debt SIPs invest your money in fixed income securities like government bonds and corporate bonds. These investments generally carry lower risk compared to stocks and offer relatively stable returns over the short term. While the potential for high returns is limited, debt SIPs can provide a safe haven for your money while you're saving for short-term goals. With short-term investments in debt SIPs, you can aim for stability and liquidity, allowing you to access your money when you need it for your short-term financial goals. Section 4. Choosing your SIP strategy, a personalized approach. Just like every dance routine is unique, your SIP strategy should be tailored to your individual financial goals, risk tolerance, and investment horizon. There's no one-size-fits-all approach when it comes to investing. If you're a young investor with a long-time horizon and a higher risk appetite, you might consider allocating a larger portion of your SIP investments to equity SIPs. As you get closer to your goals, or if your risk tolerance is lower, you can gradually shift towards a more balanced or conservative approach by increasing your allocation to balanced or debt SIPs. Your SIP strategy should align with your financial aspirations, risk profile, and investment timeline, allowing you to invest with confidence and work towards your financial dreams. Section 1. Understanding risk, the spice of investment life. Just like every dance move comes with its own level of difficulty, every investment carries a certain amount of risk. Think of risk as the spice in your investment biryani, too little, and it might be bland, too much, and it could be overwhelming. The key is to find the right balance that suits your taste buds, or in this case, your risk appetite. Risk, in simple terms, is the possibility of your investment not performing as expected, leading to potential losses. But here's the interesting part. Higher risk often comes with the potential for higher returns, and vice versa. Understanding your risk tolerance is crucial before you jump into the world of SIPs. Section 2. High-risk SIPs, dancing on the edge of potential. High-risk SIPs are like those electrifying dance performances that leave you breathless. They have the potential for impressive returns, but they also come with a higher chance of volatility. These SIPs typically invest a significant portion of your money in stocks, which can be as unpredictable as the weather. Imagine you're investing in a high-growth startup. There's a chance it could become the next big thing, multiplying your investment many times over. But there's also a chance it could struggle to take off, leading to potential losses. High-risk SIPs, such as those heavily invested in small-cap or sector-specific funds, are best suited for investors with a long-term investment horizon and a higher risk appetite. These investors are comfortable with the ups and downs of the market and understand that short-term fluctuations are a part of the game. They're in it for the long haul, hoping to ride the waves of potential growth and come out on top. Section 3. Medium-risk SIPs, finding the balance in the groove. Medium-risk SIPs are like a perfectly choreographed dance routine. They strike a balance between growth and stability, offering the potential for decent returns without exposing you to extreme volatility. These SIPs typically invest in a mix of stocks and bonds, providing a cushion during market swings. Think of it like having a diversified dance crew. Some members might excel in high-energy moves, while others bring grace and stability to the performance. Similarly, a mix of stocks and bonds in medium-risk SIPs can help you navigate market fluctuations while aiming for steady growth. Medium-risk SIPs, such as those invested in large-cap or balanced funds, are suitable for investors with a moderate risk appetite and a medium-term investment horizon. These investors are comfortable with some level of risk, but also prioritize capital preservation. They're looking for a smoother investment journey, aiming for steady growth without taking on excessive risk. Section 4. Low-risk SIPs, the steady waltz towards your goals. Low-risk SIPs are like a graceful waltz. They prioritize stability and capital preservation, offering a steady, albeit potentially slower, path towards your financial goals. These SIPs typically invest a major portion of your money in fixed income securities like government bonds and corporate bonds, which are considered less risky compared to stocks. Imagine you're investing in a fixed deposit. You know the interest rate up front, and your principal amount is relatively safe. While you might not get the same high returns as stocks, you're assured of a certain level of stability and predictability. Low-risk SIPs, such as those invested in debt funds or liquid funds, are ideal for investors with a low-risk appetite and a short-term investment horizon. These investors prioritize capital preservation over high returns and prefer investments that offer stability and liquidity. They're looking for a safe haven for their money, aiming to grow their wealth gradually while minimizing the risk of losses. Just like a beautiful symphony that resonates with your soul, investing in SIPs comes with a harmonious blend of advantages that can elevate your financial well-being. From instilling financial discipline to making market fluctuations your ally, SIPs offer a compelling proposition for investors of all shapes and sizes. One of the most significant advantages of SIPs is their ability to cultivate a disciplined approach to investing. By automating your investments, you're essentially putting your financial goals on autopilot. No more procrastination or impulsive spending. Your money is systematically directed towards your dreams, rain or shine. Think of it like practicing a musical instrument. Regular practice, even for short intervals, can lead to significant improvement over time. Similarly, consistent investments through SIPs, even with small amounts, can pave the way for remarkable financial progress in the long run. It's about developing a habit of investing, a rhythm that becomes second nature to you. Even the most enchanting melodies might have a few offbeat notes. And similarly, while SIPs offer a plethora of benefits, it's essential to be aware of potential drawbacks before you hit the high notes of your investment journey. One aspect to consider is the lock-in period associated with certain SIPs, particularly those linked to tax-saving schemes like LSS or equity-linked savings scheme. While these schemes offer tax benefits, they come with a mandatory lock-in period during which you cannot withdraw your investments. This might not be ideal for investors seeking short-term liquidity. Another factor to keep in mind is the expense ratio associated with mutual funds, which is the fee charged by the fund house for managing your investments. While a small expense ratio is justifiable for the expertise and management provided, it's crucial to compare expense ratios across different funds and choose those that align with your investment goals and risk appetite. Just like choosing the right musical instrument depends on your personal preferences and aspirations, deciding whether SIPs are the right investment avenue for you requires careful consideration of your financial goals, risk tolerance, and investment horizon. If you're a disciplined investor looking for a hassle-free way to invest regularly and benefit from the power of compounding, SIPs can be an excellent addition to your financial repertoire. They offer a structured approach to investing, helping you ride out market volatility and potentially achieve your long-term financial goals. However, if you prefer more hands-on control over your investments or require frequent access to your funds, SIPs might not be the most suitable option. It's essential to assess your investment style, liquidity needs, and risk appetite before deciding whether SIPs align with your overall financial plan. So there you have it, folks. We've taken a whirlwind tour of the exciting world of SIPs, from understanding their basic rhythm to mastering their diverse dance moves. Just like a well-choreographed performance, successful investing requires discipline, patience, and a dash of strategic planning. Remember, SIPs are not a get-rich-quick scheme. They're like a long-term dance partner committed to helping you achieve your financial goals. Embrace the power of compounding. Choose the SIP type that resonates with your investment style, and let your money waltz its way to greater heights. Start small, stay invested, and watch your financial dreams blossom. Happy investing!